Yeah, I'm losing my
Well,
edge.
today, Pete, we are talking about how fees affect profits, and it's
Good
something
deal.
that is maybe at the back of everyone's mind. Every time you click trade, you are confronted. This is one of the nice things about trading and finance. Traditionally, finance an industry that people are kind of wary of because of the lack of transparency. What's nice is all of these brokerages and trading platforms are forced to show you, what you're paying in fees to transact a stock trade, a
Right.
futures trade. And some of these, without naming names, some of these stock trading apps actually might hide some of that fees. But let's not get there. I want to talk about something that is at the back of everyone's mind, something that you see every day, but it's like one of those things that you're like, oh, I'm going to look into that, but you never quite end up researching.
Yes, until the end of the month and the end of
Exactly.
the year, when you look at your statement and say, oh my God, this isn't right.
Yeah, I paid how many thousands of dollars in commissions and exchange fees and everything else. Yeah, I mean, when I was a professional trader at the Board of Trade, it was killer. Like, first of all, we were paying for all this software that I probably didn't need, but someone sold it to me, and then also you're paying for every transaction there as well, and it's brutal. That end of the month, and we're going to talk about exactly this, which is I had to make X amount to get to break even, to even start with all these and then it's like, should I trade less because it's taking me it costs me more to trade more units, and all those conversations. It's like something that you want to do research on. But here's the thing:
you went through denial where you tried to justify it by the amount of
100%. I did all the stages. I was
financial
apologizing.
Financial fee grief. Yeah, I don't know if it's the right analogy, but I refer to this as friction. And what I mean by friction is anything, whether it be a bid offer spread or fees, anything that slows me from clearing the starting gate of starting to make money. And so, friction slows you down. And this is a big part of what friction is for traders, is these costs. And you're right. The daily incremental piece is something that sometimes we all gloss over, but when you look at it cumulatively, the material impact on what you end up with after building successful strategies and mechanics is material. So let's talk about this.
So I want to do all that. I want to do all that research for you. I want to do all that research for you today, because it's tough to be like, oh, I'm going to look into this, but then also I have my day job. It's one of those rough things where it's like, maybe you work in, IT or something like that. And it's like, oh, would I be performing better if I had a better computer? Oh, I'll do that research in my free time. And then in your free time, you want it to be free time. So we'll right now do all this research for you. And of course, all this research starts with a sports analogy, as everything should. Football gambling spreads are meant to equate matchups, Pete, and create a 50-50 trade. And I want to just use this to get people on board with the concept. And then I'm going to kind of subliminally drop some math in there for you. And we're going to resolve, hopefully, how these commissions affect your fees and how to get that effect as small as possible. You want that fee effect to be small, small, small. And so you got this spread here, right? This weekend, the Chicago Bears are playing the Indianapolis Colts. And the Colts are favored by 2.5 points, Pete. And so a football spread here, we don't need to get into all the logistics of it. Just understand that the Bears get 2.5 points because they're considered the weaker team in this matchup. The Colts have to give 2.5 points because they're favored. They're considered a better team. And so that's equating this matchup to make it so if I'm a better and I'm coming to this game because I want to pick a side, this theoretically should be a 50-50 trade given this handicapping, right?
Right. Absolutely. It is a true, right. It's a true, a binary decision with no slippage or friction. Absolutely.
And they call it, this is they call it a pick'em if they both were giving 0 points to each other. That means that they're exactly equivalent. But since, like I said, the Bears are considered a little bit weaker in this matchup, they're getting some extra points there. And now, how though would a casino or an online betting site, how would they make money, Pete? Because if you're just creating 50-50 markets, and Joe Schmo bets on the Bears plus 2.5, and Betty Sue bets on the Colts minus 2.5. The Bears win by 3. Betty Sue loses $100 and Joe Schmo wins $100. Then the casino's made no money, right? Like, yeah,
Right.
I know. Maybe I went a little bit too like 50s with the Joe Schmo and Betty Sue.
It's okay, Fonzie.
But this is where they make money. It's called the VIG or the juice, that minus 110 that's sitting right there, that I would actually almost say it's as transparent as financial commissions or fees, but it's almost like taken more for granted by the bettors of the world, because it's this idea of that minus 110, Pete, is if I bet $100, I'm not going to make $100. It's saying to me, I need to bet 110 to make $100. And you'll notice that it's on both sides. So we have a 50-50 trade where Joe Schmo, Betty Sue, they both bet $100. Whoever wins, neither of them are coming back with that full 100. That's how the casino makes money. Right. And here's the scenario filled out a little bit more here, Pete, which is the Bears end up winning. You've got the $100 on the Bears side. You've got the $100 on the Colts side. I don't have to pay anything to the person who bet the Colts, and I only have to pay $90.91 to the person who bet the Bears. That's how that minus 110 affects this. If they both bet $110, it would be $100 paid out here, $0 paid out here, and the casino would have made $10. In this instance, they've made $8 or $9.09. And so that's what the casino is doing, right? They're clipping that little VIG, that juice that you have to pay for that 50-50 bet a ton of times for all the Bears and Colts bettors, and then every game as well. This is every single game is going to have this. No one is making markets for you out of the kindness of their heart.
No, absolutely not. And you know what? It's interesting because different theoretical scenarios, whether it's betting on the direction of crude or betting on the Colts and the Bears, you're right. The facilitation of that opportunity, and we'll call the betting or the ability to pick a direction, the opportunity doesn't come with a cost, but depending on that cost, it is material in terms of long run success.
Well, I'll show you how material it is, because the math is actually pretty simple here. The success rate that you need to break even on 50-50 bets with that minus 110 VIG is a long-term edge exceeding 52.4% to reach profits. And so that's to say, in a closed environment here, I'm going to all spread markets on the NFL season, and I'm betting $100 every time. And I'm not upping or downing that bet depending on the week, or I like this matchup better or worse. And what I need, Pete, to at the end of the NFL season get to break even is a success rate that's actually higher than the theoretical expectation there. I need something working in my favor. And this is why there are, in the same way that there are market makers, there are proprietary traders in financial markets, there are professional bettors out in Vegas, there are professional bettors online who have just as complex algorithms to price all these things, because they know this percentage. I guarantee you every professional bettor understands what is on this page, and they know that they need to, at the end of the year, on all of their 50-50 bets, beat 52.4% in their success rate to have made money. And Pete, now tell me, we're going to now transition into, see, now I got you thinking math without you actually having to necessarily think about it too much. Everybody's comfortable thinking about how the Bears are going to whoop up on the Colts this weekend. And now I want to start to backdoor this into trading markets. 52.4%, that's kind of a lot to ask, isn't it?
Yeah, you would think so.
Because you're trading futures, Pete, and we talk about this. You know, every futures market is a 50-50 shot, theoretically. Right. To get 2.5% in edge in your favor, I mean, you'd be happy to get 2 or 3 or 4% every year in edge, wouldn't you?
Absolutely. Some of the most successful firms in the world right now who do millions of transactions work on the 52-48 threshold. And that is a very successful methodology for them. So you're absolutely right. That is a tremendous amount of edge.
And that's because every single day, hour, and minute, and this is the real beautiful thing. One of the things that I really love about financial markets, gambling markets, the elections coming up, the presidential market, down to every day, hour, and minute. It's a 50-50 play. Like you go back to February and you say, oh, well, the market went down, so it was 100% chance. No, right here, it was 50-50 whether the market was going to go up in the next minute, the next hour. That it's really a beautiful theory here that no matter what time frame you're looking at a 50-50 bet in theoretically in the stock market. But how people make money trading futures is by getting some of that edge, creating a strategy, creating an algorithm, creating a set of metrics that you look at that signal a trade, no matter what it is, your strategy. Getting that edge past 50% is what makes for long-term success in that theoretical 50-50 trade. And what's really nice here, Pete, is that the small exchange fees are next to nothing.
Right.
For every $100 bet, we like to talk about how our futures move about $100 on a daily basis. For every one of those daily $100 moves, you're coughing up 7 to 15 cents, depending on whether you're a subscriber to the exchange or not a subscriber to the exchange. Very minimal, especially if you are a subscriber to the exchange, for exchange fees. And then also, because our futures are so small, most firms like Tastyworks, Interactive Brokers, and everybody else down the line charge very low commissions relative to other futures markets. Larger or just different, more expensive futures markets like Bitcoin or the S&P 500, before even talking about exchange fees, which are higher than the small exchanges most of the time, the commissions on those are going to be higher as well. Right. And you can see how it affects your success rate. To be trading small exchange futures, you only need about 0.2 of a percentage point in your favor to be at that long-term break even on $100 futures trades here. And then you talk about going to something, and it's not a perfect relationship here, but something like S&P 500 futures demand a little bit more in exchange fees and a little bit more in commissions, usually depending on the firm. Now you're going to need a full percentage point on top of that. And then you talk about some of the worst scenarios, places that have not taken futures into the modern environment for trading. You're going to need that 2.5% that bettors need for long-term break even. This is huge, right, Pete? Because we talk about just getting to 5% in edge as a trader is so hard strategically. And here, with the small exchange futures, you only need 0.2 of a percentage point to get back to break even.
Absolutely. And you know what, Frank? In the world of equities, there's much more cost in going short than there is long. And that figures into those fees. It's another fee. So futures truly are, they're equivalent. You can go long or short. It's the same exact cost. It's the same exact margin requirement. It is truly a neutral security. Either side, the same expression of opinion, costs exactly the same amount. But you're absolutely right. When you talk looking at 15 cents for a non-subscriber, 7 cents for a subscriber, and you think about that and you lay that out over this period of time. And I think I love the fact you highlight the $100, the $100 ranges we like to trade, and to pull $40 or $50 out of that range. And you look at that fee structure of 7 cents or 15 cents for the round turn. It is so material to you coming out of the gate and letting your ideas determine your profit and loss, and not having to back and fill all these expenses. And the analogy is the perfect way to start this discussion, but this really breaks it down. How material this fee, because so often you look at, well, my commission versus what I'm controlling is so small. It's really not material. It's the notional I'm controlling. It's not. There is a whole series of things that affect those long, because you know what, day to day doesn't determine whether or not we are successful in this endeavor. It's really looking at this over a period of time. And this is the perfect example of how material these costs are to your success in the long run.
Absolutely. And circling back to that analogy, I love what you said about, trading stocks and ETFs. It's almost like you can only buy the bears plus 2.5 points, and you cannot sell them. You cannot buy the colts, or it's going to cost you more. I'm going to have to pay a larger VIG to do that inverse. In the stock and ETF world, futures allow you to. It's that symmetric relationship, long and short here. The fees and commissions and the margins not changing for that. And then also these small exchange futures, getting it so that VIG on, I can trade the bears or colts here. I can buy or sell, and that VIG is only requiring that I get for every 100 trades, it's not even 100. For every 1,000 trades, I just need to be 2 better than my losing column here to get to long-term break even there. And so now I'm building long-term potential profits here by just being a percentage point in my favor. And I think most people would like to think that their strategy gets them just 1 percentage point better in the win column than in the loss column. And so that is how your fees are going to affect your profits.